Oh, right. Today is Tuesday, July 12th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. And since we have an important day ahead of us tomorrow, the CPI day, inflation, let's not waste any more time. And here it is, in focus tonight. Dazed and confused. We're talking about the Federal Reserve, of course. And every time the Fed is dazed and confused, we got a problem, because this is a recipe for making bad decisions. And of course, when the Fed makes bad decisions, they don't pay anything for it. They're all set for life. But the rest of us pay the price. I want to start by talking about the jobs report that we got last Friday, because on face value, the number is pristine. The economy added, allegedly of course, 372,000 jobs in June. Now, this is a double-edged sword because on one hand, it appears that the economy is still growing and producing jobs. So far, so good, but the problem is the Fed wants to stop the cycle of job creation in the economy. Now, why would they do that? Because of inflation. Inflation is not going to go down without unemployment. Anybody who tells you otherwise is selling you a fantasy. All you have to understand is the law of aggregate demand, which will push inflation higher again. Now, you might say, hey, Maverick, well, what about before 2020? For example, back in 2019, we had record low unemployment and we did not have any inflation problem. And the Fed did not have to tighten the monetary policy and all of that. Now, here's the difference. Number one, back then, we did not have inflation expectations running rampant in the economy. Number two, we did not have a spiraling, out of control cycle of wage inflation. So a number like this means that the Fed needs to be even more aggressive with tightening the monetary policy. We'll talk about that in a second, because what if the headline number is actually hiding the reality of this economy? What am I talking about? How about you hear it from the good professor from Wharton, Jeremy Siegel? And we say the good professor because 95% of the time he's wrong, but then there is that 5%, and perhaps this is one of them. Take a listen.
Why was it weaker than it looked?
Well, two reasons. First of all, if you look at the household survey, which actually covers a lot more people, it's not considered as accurate. We're actually down in the number of jobs over the last 3 months, not up like the payroll survey. But just as importantly, and I listened to a lot of newscasts, and I think a lot of people were ignoring a tremendous drop in the number of hours worked per week. Now, when you might not think 0.1 drop, and they revised the previous month down 1/10 is a lot. But if you do the math, 1/10 drop in the work week is like a $450,000 person loss in payrolls. And in fact, we've seen one of the biggest downdrafts in hours worked over the last 15 years since going back to the financial crisis back in 2008.
Okay.
So even though the headline number looked, decent and beat the estimate, what I saw underneath there, I think showed a lot of weakness.
So does that mean that the Bureau of Labor Statistics is cooking the numbers? Perhaps, but not really. It's a flaw in the formula. The way they calculate these numbers, I mean, you got to be a fool to believe that the unemployment rate is at 3%, 3.5%. We all have the anecdotal evidence of so-and-so company freezing hiring, of your employer getting rid of certain employees. So-and-so lost their job recently, and it goes on and on. So how come that kind of data is not showing up in the recent employment report? Well, the devil is always in the details. You heard that the number of working hours in the economy went down slightly, and that can be explained by a lot of folks losing their jobs. But there is more to that, because you could argue that the jobs number that we got on Friday is actually lagging, and the most recent data, such as the initial claims for the week, actually showed unemployment claims rising higher to 6 months high, all the way to 235,000 claims. And this is yet another sign that we're seeing layoffs in the economy. And look at this chart right here. Does it look like jobless claims are bottoming and they're about to rise again? It certainly appears so, but we need to see more data. We're about to get more this week. Now, when we visit the ice cream shop, all flavors, the unemployment rate is down, but it appears that it is kind of bottoming for certain groups. And the biggest disaster of all of this is the U.S. labor participation rate. For all flavors, almost, the labor participation rate is actually ticking down. And this is what the media is not talking about, and this is what the so-called economists are not really talking about, not giving this subject the attention it really needs. The labor participation rate is down, and it did not recover since 2020. So when we talk about the difference of 2019 versus now, in both cases you have low unemployment rate, but in this case, in the current case, we have a severe labor shortage. The labor participation rate did not recover, and that means we're not going to have enough pilots, we're not going to have enough air traffic controllers, we're not going to have enough babysitters, teachers, waiters, cooks. No shortage of cooks at the Bureau of Labor Statistics, of course, but all of these shortages mean that employers have to pay more in wages, more and more and more, to attract employees. What does that mean? It's either one or two things. Either magically the workers are going to show up out of the blue and we solve the supply problem in labor, or the demand has to go down. Once again, how are you going to take demand down in the economy without job losses, without unemployment? It's not going to happen without that. And the data can be really deceiving. For example, the headline reads, unemployment rate for black women fell in June. Good news, right? Here's the problem. But so did their participation rate in the labor force. According to Ariane Hegowich, whatever that is, Senior Research Fellow at the Institute of Women's Policy Research. Okay. She says it is hard to see from this data what is exactly behind it, but black women are withdrawing from employment much more than white women. The move may signal more withdrawals from the job market and be a contributor to a downtick in the unemployment rate within the group. So you might be deceived that unemployment rate is actually going down and the economy is still creating jobs, everything is hunky-dory, but in reality, folks are actually dropping off the labor force participation entirely, which will again cause more and more and more wage inflation, assuming that the demand remains high in the economy. All what you're seeing right now in the drop in commodities and people saying inflation is gone, peak inflation, it might be peak inflation in terms of the rate of growth in inflation month over month. But still, prices are too high. This will damage the purchasing power of consumers. This will damage the standard of living for years to come, and it will cause a recession either way. So the question is, if you're the Fed, do you want to wait and see the economy die a slow and painful death, or do you want to do it fast and quick and then hope that you can resurrect the economy via easing the monetary policy once again, and perhaps at that time, the supply chain problems will be solved? Sounds like a fantasy, but these are the choices that we have right now. Otherwise, the slow and painful death means stagflation for a period of time and then a recession. That would be extremely painful for the American public and for the economy. And therefore, looking at the headline number alone, the economy created over 300,000 jobs last month. What does that mean? It means that the Fed's tightening so far is not working. But I just told you all the devil in the details. In my opinion, the devil in the details with a drop in the labor participation rate is happening due to stagflation, not due to the Fed's policy. Matter of fact, the Fed's tightening of the monetary policy will not show up until months from now. So the question is, when you look at this data, it merits the Fed to become even more aggressive, or does it? Because there is a lag, and hence the confusion by the Fed. Speaking of, let's visit the clown show at the Federal Reserve. In response to the data that we got on Friday, the employment report, we have conflicting opinions in the Fed. We have a zombie from Atlanta, Raphael Boystick. He says and supports a supersized interest rate hike at the July meeting, meaning the 75 basis points. On the other hand, we have a defector here. Remember, Jerome Powell said we're going to do whatever it needs to do, and we only care about dropping inflation down to the Fed target of 2%, and we will do whatever it takes. He's trying to be Volcker, of course. He couldn't even be Volcker's shoes, but they're already backing out. You have Esther George from Kansas City, another zombie, who says she's now concerned that the monetary policy tightening may be happening more quickly than the economy and the financial sector can absorb. My rebuttal is, where was that concern when the Fed was easing? How come these Fed zombies never say when they're easing the monetary policy, hey, we might be overdoing it here, or we might get inflation or something worse? How come that thinking didn't happen when the Fed was easing? But now, when they're fixing their own mess, they're worried about the stock market, they're worried about the real estate market, they're worried about the economy. By economy, they mean the rich and their assets, because that's who the Fed really serves, not the American public, but the oligarchs. And now we have a debate. Is it going to be 75? Is it going to be 50? Is it going to be 25? Is it going to be nothing? Is it going to be easing in the monetary policy? Long shot, but it could happen later in the year. But before you get excited that Esther George is now in the pumping / dovish side, you got Governor Waller, who says that inflation is too high and does not seem to be coming down. And therefore, he also supports big interest rate hikes. But he's also confused. He's all over the place. I don't know what kind of drugs they use at the Fed, but Fed Waller says, I support 75 basis points at the July meeting. He also says, I'm probably in favor of a 50 basis points rise at the September meeting. Watch how fast he's going to backtrack if the stock market goes down another 10%. Waller also says, it is not clear to me that we are going to have a recession despite news on GDP. He's talking about the negative GDP estimate. So wait a minute, when you have a negative GDP quarter after quarter, yet it's still not clear to you that the economy is heading into a recession. We have a yield curve inversion, the likes that we've never seen before, and you're still doubting a recession. Perhaps it is time for new glasses, Mr. Waller. He also said the decline in housing prices of the last 2 years is insane, and insane indeed. But he also says that the Fed is not trying to crash housing or commodities markets. So housing prices are insane, but you're not trying to crash them down. I guess we have to ask them, pretty please, go down. Maybe they'll do it. And then you have, of course, our favorite, the zombie from St. Louis, James Bullard, who came out and said that the U.S. economy is solid. And on top of that, it can handle rising rates. And I say, Mr. Bullard, I dare you. I double dare you. Do it. Do 100. Instead of 75, since the economy is so strong and it can handle rising rates, do 100 basis points. Better yet, you said that the interest rates should rise higher by year end to 3.5% minimum. So why not do it now, since the economy is so strong and it can handle rising rates? I dare you. Of course he's not going to do it. But the optimism from Mr. Bullard is too high. Matter of fact, he says there is a good chance of a soft landing in the U.S. economy. Oh, really? How is this for a soft landing? Today, we got the Small Business Optimism Index, and it dipped again in June. Matter of fact, the monthly index hit a record low. Look at this. The Small Business Optimism is down. It is collapsing. And in orange, we have the outlook for business conditions, and that dropped to all-time low. This is the booming economy, folks. But that leads us to the CPI, because the Fed can talk whatever they want. At the end of the day, if the cooked inflation data, the CPI, which grossly underestimates the true nature of inflation in the economy, if that doesn't cool down, they got a major problem, because they can argue all they want that there is a lagging impact between when the Fed raises interest rates and between when we see the impact in the economy. You can do that all you want. If the CPI reading comes out tomorrow, for example, showing 9% plus inflation in the economy, and better yet, moving higher month over month, inflation expectations will move higher, and they're not going to stop, which now becomes a cat and mouse game. The Fed has to continue to be more aggressive, meeting after meeting, to crush inflation expectations down. And then the lagging impact will show up perhaps in the fourth quarter, or maybe next year. We will see that recession being amplified. Now, a lot of you are saying, what are you saying here, Maverick? Are you saying that the Fed doesn't have to increase interest rates higher? Of course not. They have to. They got no other choice. The other choice is stagflation and a slow, painful death of the economy. Would you like to experience that? But the estimate for now, for tomorrow's number, that the reading will be above 8%, a matter of fact, will increase month over month. The majority of the experts and the analysts are saying 8.8%, 8.7, 8.9. So let's say 9%. Now, what supports a 9% plus reading, and what supports a lower reading, perhaps 8.4, 8.3, even 8%? Before we talk about that, I have to warn you, because a lot of folks today were passing what is allegedly a leaked version of the CPI that we're about to get tomorrow. And in that leaked version, it shows a reading above 10%, which is a lot. A reading of 10% will crash the stock market tomorrow. Be careful, because who's the leaker, by the way? Who leaks such information? I'll tell you who. The predators. The people who want to set traps. So you get that kind of news and you say, okay, the CPI will be over 10% tomorrow. So you're going to short the stock market. You're going to buy puts. What do you know? Tomorrow in the morning, you wake up and the CPI is actually reading 8.4, 8.3. And we start to hear talk about peak inflation, and the equities market shoots up higher. and now you get a massive pie in your face. Now, can you be right? Of course you can. The CPI can read over 10% in the morning, but you took the trade based on a shot in the dark, hoping that the information that you saw today is real. You're depending on luck. That's not a strategy. But now let's talk about what supports a lower reading in the CPI, what supports a higher reading. What supports a lower reading is the obvious: the drop in gasoline prices at the pump. Now, before you get too excited, in the beginning part of June, gasoline prices were at record highs, and then they came down. So you could say that the drop in gas prices actually cancels the surge that we saw earlier in the month of June, and therefore that's neutral. But what could also support a lower CPI is large ticket items. For example, used cars, although the supply remains tight. And what we're seeing right now in the cars market is stagflation, a lower, declining pace of economic activities because people are not buying cars anymore as rates continue to move higher. But at the same time, the prices are not going down, and hence stagflation because there is no supply. So you can see already that the arguments for a lower CPI are kind of weak. What about the arguments for a higher CPI, 9% plus? What could support that? The answer is the big one, the lagging indicator, which is rent inflation. And folks, rent inflation in this country is out of control. I have never seen rents surging out of control like this before. It is absolute insanity. We're seeing rents costing more than actual mortgages. In certain cases, rents are moving higher by more than 100%. But unfortunately, this is an underreported fact in the media and the so-called economists and the Fed and the Bureau of Labor Statistics. We say that the most dangerous kind of inflation is food inflation, number one. But number two, the most dangerous is rent inflation. Why? Because when you have consumers paying more for rent, they're not spending more in the economy. That eats away from their purchasing power. And of course, the money goes in the pockets of greedy landlords, aka pimps, who sit in their asses and contribute nothing to the economy besides cashing a check every month. Now, that check goes into a savings account, into an investment account, but you're not going to see landlords splurging in the economy with the extra gains. And therefore, higher rent always produces a stagnation impact in the economy. Now, of course, a lot of you might get mad if you happen to be a landlord, you have a little condo or guest house that you're leasing. I'm not talking about you. I'm talking about these greedy types, corporations who scoop up a bunch of single-family homes, taking that supply from families who need these homes and turn them into rental homes. Therefore, it cannot wait for the housing crash, because this is the only way to crush these greedy bastards. That practice and that behavior gotta stop. Otherwise, the supply-demand imbalance in the housing market will stay with us and housing prices will not go down. Back to the CPI, rents have been increasing dramatically in the last few months. But the CPI did not reflect that at all. Number one, because they have a cooked formula that will downplay the true nature of rent inflation anyways, but because these geniuses also, the way they calculate rent inflation, there is a lagging impact. The rent increases that happened in November of last year will show up in maybe March of this year, June of this year, so on and so forth. And there is another problem for the Fed when it comes to rent inflation. It's not going to go down anytime soon. Not just because the lagging impact in the formula, but also because of the fact that the Fed is raising interest rates and that is causing mortgage rates to move higher. What am I talking about? Here it is. From the New York Times, the headline reads, "Relief eludes many renters as the Fed raises interest rates." As the central bank raises interest rates to cool down the economy and contain rapid inflation, it is also pushing up mortgage costs. What is the problem with that? Here it is. Pushing home purchases out of the reach of many first-time buyers. If people who would have otherwise bought a home remain waylaid in apartments and rented houses, it could compound already booming demand, keeping pressure on rental prices. Da, 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 da. So now you have a dynamic where, to begin with, there are no homes. There is a massive shortage of homes, and the prices are out of whack. But on top of that, mortgage rates are moving higher. In other words, this is not a good time to buy a house. So what do you do instead? You rent a house, you rent an apartment for now, and that increases the demand on rents, pushing those prices further higher. This is a major, major problem for the Fed, and they have absolutely no control over it. Besides, pushing unemployment significantly higher, and then that demand goes down. Continuing, while it is tough to predict how big or how lasting that Fed-induced bump in rental demand might prove, it could ironically make it more difficult for the central bank to wrestle inflation lower in the near term. Rent-related costs make up nearly 1/3 of the closely tracked Consumer Price Index inflation measure, aka the CPI. So anything that helps to keep them climbing at an unusually brisk pace is likely to perpetuate rapid inflation. Big problem for the Fed. So when you talk about peak inflation, talking about the recent crash in commodities, or even if we get a lower CPI reading tomorrow, the problem remains the same. Prices are too high, rents are too high, and this will stagnate the economy. When consumers are spending more on rents, that will take their purchasing power away. On top of that, just so you know that the damage in the economy is already done, these are long-term obligations that the consumer cannot get out easily. When it comes to rents, you sign a 1-year lease, so you're locked in. Your purchasing power will be down for at least a year. And if prices don't go down, you're still going to live with a lower purchasing power and a lower standard of living regardless of what the month-over-month reading in the CPI shows. Another problem. When we talk about the strong consumer and re-stimulating the economy, perhaps inflation is peaking, the consumer is still strong, the economy is going to recover, stocks go higher, and everybody lives happily ever after. Bullshit. Why? Here it is. The average car payment in the United States climbed to a record high, $712 a month in June. As borrowing costs increase, interest rates move higher, you're going to pay more for your car. So now you're going to pay more for rent, you're going to pay more for your car, you're going to pay more in utilities, you're still paying more at the gas pump, at the grocery store. This is how the economy slowly but surely transitions from inflation, the so-called boom, which is not really a boom. It is actually what Dr. Friedman describes as the honeymoon phase of inflation, and then we transition to the ugly phase of inflation when companies cannot pass the extra cost to the end consumer. Then that transitions to stagflation, and stagflation transitions into a recession. It is getting so insane in the cars market. Matter of fact, luxury cars buyers are now shedding more than they're paying for mortgages. Unbelievable. Now you might say this is a problem for the rich, Maverick. Not really. Have you ever lived in LA where, God forbid, you drive anything besides a BMW or an Audi? You might not pass the audition. It's a fake life, but that's LA for you. You got people living in studio apartments, leasing BMWs, paying $700, $800, over $1,000 a month for a car. And just look at the impact of rising interest rates on the monthly payment you're going to make on the average standard $30,000 auto loan with a 72-month period. At 1% interest rate, your interest payment all in all is going to be $921. At 5%, that same payment goes higher to $4,787. At 10%, your interest goes higher to $10,016 from $921 at 1% to $10,016 at 10%. So again, if the Fed continues to increase interest rates higher, and we don't see loss of jobs in the economy, and the aggregate demand continues to hold on, the economy enters stagflation because all of these payments will go higher and higher and higher for the consumer. They're not going to be able to dine out. They're not going to be able to fly or travel or go to casinos. And therefore, the cyclical stocks, the travel kind of stocks, are at the most risk right now at this stage of this economy. What is fueling these stocks and these companies for now? The answer is credit cards. The consumer, if they want to go experience some leisure, they've been locked down for 2 years now, over 2 years for certain folks. They might be paying more at the gas pump and rents, for the car payment, the grocery store, but they want to get out. They want to get out. The only option is swiping those credit cards up and down, up and down, up and down. And therefore, we're seeing consumer credit surging higher to another record high. Now, I showed you examples of what's going on with increasing interest rates, mortgage rates in this case, what that would do to the rental market, and the increasing interest rates on car loans. That means you're going to pay more, and if you're going to pay more, you're going to cut expenses otherwise. What about the increase of interest rates on what you owe in your credit card? That's the big one. That is the one that will cripple down this economy, and it will get even worse if we see higher unemployment in the economy. You racked in all of that debt, interest rates are moving higher and higher and higher, and oh, by the way, you just lost your job. That is the most dire scenario. And let's hope we're not going to get there, but it's kind of hard to see. And this inflation disaster is causing 71 million people into poverty worldwide. In this country, the richest country in the world, 1 in 2 Americans say that they're struggling financially due to the soaring cost of food and gas. And oh, by the way, add rent, utilities, car payment, child care, and it goes on and on. And there is another wrinkle that will keep inflation higher. Not the organic aggregate demand, but the artificial aggregate demand. How could that happen? Well, how about another round of stimmies? Or you might want to call them relief checks. Yep, you have all of these states, led by California, to tackle inflation. They're creating more inflation by sending checks to even folks who earn more than $100,000 a year, which in California, that's nothing, but it illustrates the problem. You have these lunatic politicians who are so afraid of losing their power this coming November, and they want to bribe the public at the cost of keeping inflation higher. So once again, a major problem for the Fed. And speaking of voting, for all of you who voted for Joe Biden, hoping that he's going to cancel your student loans, good luck. Because Joey B., to prevent this inflation from moving higher, no, they're not cutting the insane spending all over the place or changing their stance on the energy policy, for example. No. Not any of that. What they're going to actually do is throw you under the bus. They gave you a grace period. They did not charge you for your student loans. But that could be over now because Joey B is thinking about restarting loan payments once again. Because when you're not paying your loans, you're splurging in the economy with that money and you're creating more inflation. So pay your bills, damn it. Come on, man. And oh, by the way, the interest rates continues to move higher. And with this problem, once again, I'm not the only one saying this. We need a recession. We need higher unemployment. Not because I'm wishing for that, but because this is the only remedy right now. We're out of choices, folks. There is not going to be any soft landing bullshit. That's not going to happen. And even Bank of America says a deep recession is needed to bring down soaring inflation, and high prices are going to be very sticky. Sticky indeed. You might jerk off to the crash in commodities, peak inflation, but then what happens when inflation sticks? When it doesn't go down to the so-called Fed's target of 2%, that will require more and more interest rate hikes on a weakening and an injured economy, a recipe for a disaster. And therefore, the confusion all over the place by the Fed is extremely dangerous. We need consensus. We need clear strategy from all of the zombies. But if you thought that the call from Bank of America is a little fuddy-ish, here is Goldman Sachs for you. Goldman Sachs economists doubtful that the U.S. already in a recession. And they made that call while passing drinks at the bar. And the lesson of the day, folks, did you see what happened in Sri Lanka over the weekend? Protesters storming the palace, presidential palace, overthrowing the government, storming the premises of the Central Bank of Sri Lanka. You think those images cannot be replicated in Western countries? Think again. But the Fed will upset the population either way. They're either going to cause a deep recession or they're going to cause stagflation, a misery for the economy and the population. In either case, both are dire scenarios. Both will cause severe anger by the public and the ramifications that come with that. But hey, if all of this scared you and you're saying, hey, Maverick, what's up with the darkness? Rest assured, you can always escape this miserable life and live in the metaverse peacefully. You don't need a job. There is no inflation, but there is a catch. You got to give up your legs. That's the price to pay to live in peace and no inflation and no misery. Think about it. But in the meantime, in real life, we got a stock market to cover here. So let's move on and we start with the closing of the indices today. And here we go. We got an end of the day slump, and the Dow Industrial Average closed down by 192.51 points, or a loss of 0.62%. The Nasdaq down by 107.87 points, or a decline of 0.95%. The S&P 500 also down by 35.63 points, or a decline of 0.92%. The sectors' performances, shame on all of them. We're not going to give any medals today because all of them closed in the red. And the decliners were led by energy, technology, and healthcare. Interesting, right? You got energy, the inflationary / commodities, and technology, the disinflationary, lower interest rates kind of trade. Both of them leading the declines today. What does that say? We have confusion here. We have perhaps pre-CPI fear. We'll see what happens tomorrow. But here's the advanced decline ratios. NYSE, 42% advancing versus 54% declining. The Nasdaq, 44% advancing versus 51% declining. Commodities, the WTI was down big today. It's not showing it here because I took the screenshot a little too late. But the WTI was down over 7.5% today. Brent, similar decline, massive decline for crude. You will know why in a second, but the RBOB gasoline was down by almost 1%, so did the heating oil. Natural gas bucking the trend with a rebound of about 1.25%. Here is some energy news for you. Of course, a lot of traders are dumping crude futures. Why? Because we have the upcoming visit by Joe Biden to Saudi Arabia. And the assumption is there's going to be a lot of begging, a lot of promises, a lot of quid pro quo kind of deals. I give you jets, you give me more supply of oil, I give you something else, etc., etc. This is the assumption right now. But you might have heard back in the G7 meeting, President Macron of France did warn Joe Biden that the Saudis don't have the capacity to increase production at all. And if that is the case, Joe Biden is wasting his time. He's going to go over there, beg for mercy, and nothing will happen. And if that is the case, we could see a rebound in crude futures. But in the meantime, the driver for now will be the CPI. If the CPI comes out too low, then that would be an indicator that the economy is transitioning from inflation to stagflation and then a recession. And hence, energy prices will go down. Yet there is another double-edged sword, a tailwind/headwind for crude prices, depending on how this will materialize, and this is the price cap on Russian oil. This effort is spearheaded by none other than Janet Yellen, aka Transitory Yellen. Remember that one? Well, she wants the price cap on Russian oil, and for now, this is acting as a headwind, pressuring crude prices down. But could it turn into a tailwind, causing crude prices to soar? Yes, it could. Here's how. The global price of oil could surge by 40% to around $140 a barrel if a proposed price cap on Russian oil is not adopted, along with sanction exemptions that would allow shipments below that price. U.S. Treasury Secretary Janet Yellen will discuss implementation of the U.S. price cap proposal and global economic developments with Japanese Minister, whatever that is, Suzuki, when they meet later on Tuesday. The goal was to set a price at a level that covered Russia's marginal cost of production, so Moscow is incentivized to continue exporting oil, but not high enough to allow it to fund its war against Ukraine. Japanese officials had expressed concern about the price cap being set too low, but had not rejected a potential price range of $40 to $60 a barrel outright. What is the problem with all of that? Here it is. Yellen is using her first trip to the Indo-Pacific region as a Treasury Secretary to build support for the proposed price cap on Russian oil and answer nagging questions about its efficacy if India, China, and others now buying cheap Russian oil don't participate. You think the Chinese and the Russians are going to the Chinese and the Indians are going to piss off the Russians? Not a chance. They're getting cheap oil right now, and they're not going to experiment with Janet Yellen of all people. Transitory Yellen. You really think she's going to get this thing right? Of course not. And that leads us with all this talk about sticking it to Putin. Well, how is sticking it to Putin going on right now?
Sticking it to Putin, Brian.
Well, here it is. Russia's current account surplus hit a record as surging revenue from energy and commodity exports helped offset impact of international sanctions. Once again, Matter of fact, even Brazil, President Bolsonaro says that Western sanctions against Russia have failed, entirely gone. And now Bolsonaro says a deal is close to buy cheaper diesel fuels from Russia. So much for sanctioning, right? And who's paying the price right now? Beside the Ukrainians, of course, the West, the Europeans, the Americans, not the politicians, of course, but the public. And now we have talk about impending doom for the European economy if Russia decides to shut down natural gas supplies entirely to the European Union, but specifically Germany. For now, Russians decided to cut down the supplies from Nord Stream 1, but their excuse is they need a piece of equipment from Canada to maintain the pipeline, but they're not getting that due to the sanctions. So here's what happened. Here's how sticking it to Putin is working out. The U.S. government backs exporting sanctioned pipeline equipment to Germany. You mean to Russia? Giving a diplomatic boost to Justin Trudeau, that's dictator Justina, after weathering criticism from Ukraine and its large diaspora in Canada. Justina tried to play tough by saying, we're not giving the equipment to Russia. We're going to stick it to Putin. And then the Germans responded and said, would you like to see what the collapse of the European economy looks like? Because that's exactly what's going to happen. And then, of course, Biden put more pressure on the Canadians to release all of that equipment despite the sanctions. And of course, that pissed off the Ukrainians. Ukraine is furious at Canada for waiving sanctions on a crucial pipeline part that Putin needs to sell gas to Europe. And you watch. If you are Ukrainian, by the way, I feel bad for you because they're going to throw you under the bus so fast, you're not going to even believe it. And that clown that you got as president, when all of these Western economies dip into a recession and Putin decides to take Kiev again, we're going to fly this guy all the way down to Florida. He's going to live in a big mansion with his Cayman accounts, and you'll be left with your pants down under the Russians' rule. That's the sad reality. And we're already seeing that kind of sentiment showing up in the media. In the beginning, they were all in. We'll do whatever it needs to be done to support Ukraine and beat Putin. Now that the war is prolonging and we're seeing the negative economic impacts on Western economies, all of a sudden even the New York Times, the biggest warmongers on the planet, even the New York Times says Ukraine's demands for more weapons clash with U.S. concerns. Why? Because apparently we're depleting our own military, and there is a limit on how much we're going to support Ukraine, despite what Joe Biden says, that there is no limit. We'll do it for however long it takes. And the American public has to endure the pain however long it takes at the pump. All of a sudden, that sentiment is being retracted, little by little by little. And once Western economies dip into a recession, we see public outrage in the streets. They're going to throw the Ukrainians under the bus so fast. As long as the LNG deals stay, as long as the Germans buy U.S. LNG from this point on, we're done with Ukraine. Mission accomplished. Anyways, back to the futures. When we talk about softs, down across the board, led by OJ, down almost 5% today. Cotton down big, over 4%. So was lumber, down over 2.5%, now below 700. Coffee down big, almost 3.25% to the downside today. Cocoa down by almost 1%. Sugar was the mildest decliner, losing about 0.69%. Now, what about metals? These prices are not updated, by the way. This is not how metals futures closed for the day, but take my word for it, they were red for the day, down across the board. Gold down, silver down, platinum down, copper down, palladium down. Palladium was down big today, losing over 7% almost. But my eyes are laser focused on copper, because copper is the leading indicator. And so far, copper has been crashing like you've never seen before. Actually, we did see it before. It's called 2008. Anyways, what about meats? Green across the board, gains for live cattle, feeder cattle futures, with big gains of almost 3% today, and we have lean hogs also scoring modest gains of a little over half a percentage point. The opposite story in grains, red across the board, soybeans down, soybean meal down, soybean oil down, corn, wheat, all down. Wheat down over 5%, corn down almost 7% today. So again, you could say that this is the end of commodities inflation, and therefore the inflation problem is gone, the economy is going to recover, stocks are going to recover, and everybody's going to live happily ever after. But go back to 2008. Did we live happily ever after? Of course not. A recession hit. The decline in commodities, the crash in commodities, was a leading indicator that the economy is about to dip into a recession. And this is exactly what happened, and this is exactly what commodities are saying right now. Now, you might ask, how do you know that, Maverick? Why do you say that? Why isn't it a decline in commodities, a crash in commodities, whatever you want to call it, is the end of inflation, the economy stabilizes, and we live happily ever after? Well, the answer to that is you have to combine more data into this argument. So you have one camp who says the crash in commodities is peak inflation and the inflation problem is gone. Meanwhile, unemployment is low, the economy is strong, and therefore we will see a massive recovery. On the other camp, you have folks like me who say that the crash in commodities is a leading indicator for a recession. Commodities are going down for the wrong reasons. How do we know who's right and who's wrong? You have to combine more data. For example, what's going on in the yield curve? Is the yield curve steepening? Because if that was the case, then the camp who says peak inflation, the commodities crash means peak inflation, are right. But this is not what we're having right now. We have the yield curve inverting, and that indicates that the camp who says the crash in commodities is a leading indicator for the upcoming recession, they're right. And there are more pieces of data that we can use that support the bearish theory, not the bullish one. Moving on to the options market, the casino, what's going on here? Apple came up number one at around 1.4 million contracts. About 49% of those were calls. And at number two, Tesla, the souffle, at around 1 million contracts traded for the name today. About 52% of those were calls. And at number three, Amazon, at around 800,000 contracts traded for the name. About 60% of those were calls. Maybe some Prime Day optimism? We'll see. I bought some Amazon calls, by the way. We'll cover the chart if we have time. But before we do that, that, here are the unusual activities that took place in the options market today. We start with the ticker EWZ for the Brazilian ETF, and this is a proxy for commodities. So here we have somebody buying calls. They're betting for a rebound in commodities. They bought the 27.5 calls for the expiration date, July 29th, with the expectations that the EWZ could rebound higher by more than 5% by then. They paid around 40 cents apiece to enter this trade, all in all spending around $2.2 million. And pay attention now. I don't read these trades just to present it to you. I read these trades as a pulse for what traders are thinking. What are they betting on? What are they predicting? And in this case, for the XLY, this is for consumer cyclicals, which have been surging as of late. Somebody's fading the rip by buying the 130 puts for the expiration date, August 19th, with expectations that the XLY will go down by more than 8% by then. They paid around $3 a piece to enter this trade, all in all spending around $2.4 million. Now, the XLY goes higher hand in hand when we have risk on kind of mode, when technology goes higher, when the RKKs of the world go higher. So somebody's betting that we will see a reversal, an end of the bounce, at least according to this trade. And then we have the ticker BA for Boeing, aka the flying coffin. Now, I've made the mistake in the past, of being bullish on the flying coffin, at least for a moment there. Some of you remember that, but I was wrong, because the flying coffin is trash. But perhaps that's changing for now, at least according to this trade. Somebody bought the 160 calls for the expiration date, July 22nd, with the expectations that the name could move higher by more than 9% by then. And this is on the heels of the deliveries number that we got today, which boosted the stock higher, some short covering. And perhaps the short covering will last till the expiration date of this trade. They paid around $1.25 a piece to enter this trade, all in all spending around $700,000. And then we have the ticker AAPL for Apple, the big kahuna. Somebody's bidding for more gains to come. They bought the 155 calls for the expiration date, August 12th, with expectations that Apple could move higher by more than 6% by then. They paid around $2.50 a piece to enter this trade, all in all spending around $1.2 million. And lastly, at the bottom of the table, what about the ticker VXX? This is a proxy for the VIX. Somebody's betting for a spike in the VIX by buying the 24 calls for the expiration date, August 29, with expectations that the VXX will pop higher by more than 7% by then. They paid around 75 cents a piece to enter this trade, all in all spending around $375,000. Now, the overall theme from these trades, mixed. You have the EWZ trade betting for a rebound in commodities. You have the XLY betting for a decline, and that comes hand in hand with the EWZ. If commodities are moving higher, then inflation is moving higher, and names like the XLY and the XLK technology will go down. Then we have Boeing, that's independent, that's company news. But we have Apple, somebody's betting for Apple to continue to move higher. It's hard to see how the NASDAQ will go down without Apple going down. And then we have somebody betting for the VIX to move higher. So mixed signals here, they're all over the place. It's all about the CPI, baby. But anyways, moving on to the heat map analysis, what's going on here? Again, mixed, confusing. Just look at Apple versus Microsoft. Apple closing in the green, Microsoft down big, losing over 4% because we have bad news from Microsoft, which we're going to cover in a minute. But let's look at the themes. Energy remains down. At some point, it's going to get oversold. At some point, we're getting an oversold rally. Whether that's sustainable or not, that depends on the news from Biden's visit to Saudi Arabia, number one, and the CPI report. And on top of that, what happens with the Russian price cap. But other cyclicals are down. In materials, for example, a lot of you asking me, what about FCX? Are you still holding FCX Freeport? The answer is no. I told you already a while ago. I'm dumping all of the cyclicals. Copper, steel, all of them. Fertilizers. We're done. At this stage of the game, you don't want to rely on the consumer's purchasing power for the obvious reasons. We talked about them in the beginning of this video. You want to rely on the government's spending power. That is big pharma, that is the defense contractors, and of course, certain consumer staples because they have the power, be it in inflation, be it in a recession. It's a necessity. You have to pay for it either way. You also got the ultra defensives in utilities and REITs. For now, I'm sticking with those until things change. And I need to see fundamental reasons why things are changing. I don't want to see pops for a day or two in tech or cyclicals, the travel names, and then that fades away right away. I want to see a sustainable shift one way or the other. That has to be supported by the fundamentals. Anyhow, let's talk about corporate news and how it impacted the heat map. We start with Macau Casinos in Macau are being shut down due to the rise of the thing once again. Yesterday, we saw massive declines for names like Las Vegas Sands and Wynn, but today they're catching a rebound. Look, the Chinese are going to continue to lock down, not just because of the thing, but because we have an election coming. And somehow Xi Jinping believes that the lockdown will support his bid. I don't know how that works, but this is how it is right now. So we're avoiding all Chinese stocks, no attachment for now whatsoever. And then we got Coinbase, and the CEO of Coinbase says, nothing to see here, the company has no risk of bankruptcy, which means there is a high risk of bankruptcy. So pay attention to that. And then we have the airlines, they all popped higher today. Why? Because we have the thought right now that the dollar went higher. What does that mean? Well, it means that American tourists can afford to go to Europe for cheap. So unfortunately for the Europeans, you're going to see a lot of obnoxious Americans visiting your country soon. But as long as they pay, right? Who cares? And then we got news from PepsiCo. PepsiCo announced earnings today in the morning. And check out this. They're increasing prices higher, but even with increasing prices above 12%, they're still not catching up with the cost of inflation. So they're resorting to smaller sizes, aka shrinkflation, which a lot of gents are familiar with, but it's now happening to the Pepsi can. This is what inflation does. And by the way, all of this shrinkflation is not going to reverse. I promise you. Even when the economy hits a recession, inflation is gone, and years from now, those cans are going to remain small in size. And they're going to get smaller, smaller, and smaller. And the companies will charge you more and more and more, as high as they can get away with. And you know what I say about that? I hate that shit. If you're going to reduce your sizes, shrinkflation, I'm not buying your product. And if we all do that, it is the only way to reverse shrinkflation. Then we got bad news for Starbucks. They're closing 16 stores because of crime and rampant drug use. Now pay attention to crime, because crime is surging across the country, all over the place. And that adds to inflation. Why? Because you got retail stores now having to hire security guards. That extra cost will be passed down to you and I, the consumer. And the problem with all of that is retail stores get punished. They have to hire more security, but Amazon doesn't have to worry about this problem. The thieves, the criminals are not hitting Amazon warehouses. They're hitting stores. And in this case, Starbucks stores. And the majority of these stores happen to be in, you guessed it, liberal cities. Portland, Seattle, LA, Philly. Why? Because we have these lunatic, woke monsters, politicians, and attorney generals who are allowing this kind of crime to run rampant in their communities, choosing the side of criminals over regular, law-abiding citizens. So much for paying taxes, right? Because God forbid, you enforce the law, you punish the criminals, you protect businesses, you protect the citizens, the law-abiding part of the community. God forbid you do that, and you become not woke enough. And this is hitting Starbucks really hard. Now it's 16 stores, and as the crime wave continues to get worse and worse, we're going to see more stores shutting down. Now I go to Starbucks a lot because it's 1 block from my house, even though the coffee tastes like ass, but I don't go there for the coffee. I go there because the employees, they know me by name, they say hi, we chat, and I grab a cup of coffee that tastes like ass once in a while. But that store is filthy. It's absolute filth. Homelessness all over the place. So if CEO Howard Schultz is watching, the only reason I'm consuming your coffee that tastes like ass is the employees. So you better treat them right. What about Microsoft? Here's the news from Microsoft. They say that they're cutting a small percentage of employees as the new fiscal year begins. And by a small percentage, they mean 30%. Anyways, we have Peloton, who's now saying, because Peloton is in the trash, it's on the verge of bankruptcy right now. But their genius idea is to outsource manufacturing, and they're just going to stick the brand name on the bikes. So what is the advantage right now of buying a Peloton versus the other crap? I say this company is going bankrupt either way. And then let's talk some EVs here. We have Toyota. Toyota is debuting the Crown on July 15th. This is the ticker TM, and it might cause the stock to catch a bit. But Toyota has been off their game as of late, and the risk that this is going to be another piece of trash is highly likely. And then what about the souffle, Tesla? We have increasing competition in the US, in Europe, in Australia, in China, and this is causing Tesla to lose market share. But for now, Tesla maintains the pricing power that other manufacturers perhaps don't have. Regardless, it's tick-tock for Tesla. Just a matter of time, folks, before the whole charade goes down. The stock cannot maintain this valuation. It needs more growth, it needs higher market share, and the opposite is actually happening. And of course, we continue to follow the Musk versus Twitter saga, or Twitter versus Musk saga, I should say. Well, Twitter already filed a lawsuit in Delaware, accusing Musk of wrongful termination and describing his accusations of the company's bots and spams and scams as invalid and wrongful. This is going to be really interesting, but there is a big price to pay for both sides. Whoever loses will pay a dire price. We talked about Musk. We're going to talk about Twitter in another video. But here it is. We have the ticker GOEV, I believe, Canoe, surging higher today. And the reason is Walmart has agreed to buy a fleet of Canoe's forthcoming electric delivery vehicles as the retail giant looks to bolster its e-commerce delivery service. And this was bad news for Amazon. Amazon was down. And here's the last piece of news. For Netflix, NFLX, the streaming hit Stranger Things is kind of doing strange things to the culture. And among these strange things is bringing back the good old times, the 80s, while maintaining the wokeness, of course, with the latest example being Metallica's Master of Puppets. Remember that one? Well, that song caught a streaming bump worth 650%. And my bet is, my prediction here, we're going to see the comeback of mullets. You watch. You think I'm joking, right? Anyways, moving on to the heat map for the ETFs. Anything to see here? More confusion, more muted activities across the board. While growth was down, the XBI, which usually tracks growth, was actually higher. So we'll see who wins at the end of the day. One of these two will be right. Is it the XBI? By the move higher, we see the CPI delivering, whatever that means, to the stock market. We see growth surging higher tomorrow, and then we know the XBI was right. Or the CPI is not going to deliver, and we see the XBI growth all down. And in this case, the outperformance of the XBI is just a head fake, while the IWF and the VUG, all of these growth indices, were correct to be down today. Besides that, energy down, the commodities are down, gold, gas, UNG, OIH, even solar, TAN, uranium, everything is down. But this is the calm before the storm, waiting for the CPI for more clarity. In the meantime, let's move on to charts, and we start with SPY, the S&P 500, 30 minutes chart. What do we see here? Obviously, the chart tried over and over and over again to reclaim 385 as support. That did not happen. And then came the rejection and the flush down. Now, what are the bears seeing here? Let's remove all of these markings, and here it is. The bears are seeing a head and shoulder formation, which should take the chart all the way down to at least the support at around 372, 373. The bulls are arguing, forget about the head and shoulder. This is a 30 minutes chart. You cannot look at it this way. But look at the RSI instead. It is getting oversold. What does that mean? The chart is primed for a bounce, but we need a catalyst for the bounce. Could the CPI be the catalyst for the bounce? This is at least what the bulls are waiting for. For now, technically speaking, the bears have the better argument, but it all depends on the CPI. Here's the daily chart for the continuous contract for the SPY. The bad news for the bulls, the chart lost 3,855 as support. That's number one. Number two, the volume went higher on the selling side. But the good news for the bulls is the fact that the momentum indicators, the RSI and the MACD, are still holding and showing green impressions, showing positive momentum, at least for now. But the MACD is a lagging indicator, so you have to factor that in. But for now, the bulls are saying, wait a minute here. We're still forming a series of higher lows. And if that holds on, the last challenge that we have, assuming the chart recaptures 3,855 as support once again, is 3,960. If that's beaten, then we're done here. We're going to have a nice summer rally. The bears will counter and say, if you switch to a line chart and remove all of these markings, what do we see here? We see a formation of a bear flag, and the bear flag is already kind of playing out. Sooner or later, we're going down to 3,600 at a minimum. For now, technically speaking, looking at the daily chart, who has the better argument? I would say the bulls. The bulls for now are still supported by the fact that the chart is showing a series of higher lows. Once that removed, once the chart makes a lower low, then all bets are off and the bears are back in charge. What about the 30 minutes chart for the Qs? What's going on here? Last time we talked, we had the triangular pattern, which played out to the downside. And now the Qs is all the way down, seeking support from 285. Will 285 provide support? That depends on the CPI, unfortunately. The technicals are important, but so are the fundamentals. For now, the bulls could argue, look at the RSI. It is getting oversold. We have 285 as support. All we need is a boost from the CPI spark, and this chart could rebound higher again. The bears say, forget about it. The chart failed twice in what it appears to be a double top at around 297. The chart never made it above that, and that means sooner or later the chart will lose 285 support, and the next stop could be 274.65. Maybe a little above that at 275, but regardless, down we go. Who has the better argument for now? I would say the bulls, slight advantage. And the reason is they got the RSI, they got 285 from now. We got a little bounce by the end. All they need is the CPI to be supportive for a bounce. It's going to happen. Here's the daily chart for the continuous contract for the Qs. Everything we said about the SPY is applicable to the Qs. From the series of higher lows to the bear flag, everything is applicable. All the arguments are available here. But for now, did the chart lose any important support? Not for now. Matter of fact, the support of 11,689 remains intact. Yes, the chart is struggling to break above the resistance at around 12,207, but it's not a failure yet until the chart makes a lower low. For now, it knocked once, it knocked twice, and maybe third time is a charm when we see the chart breaking above 12,207. This is what the bulls are hoping for, but there are some warning signals here. The volume went higher on a down day. The sellers are showing up again. The momentum indicators are kind of weakening. You look at the MACD indicator that is curling down. Maybe soon enough, it's going to cross, producing red impressions on the histogram. So we have a critical day ahead of us based upon the CPI reading. What about the IWM, Russell 2000, small caps from a 30 minutes perspective? Last time we talked, I showed you the lower high in the pattern, and that did play out, and the support of 174.22 was not even in consideration at all. The chart went down all the way to 172.25, and it went back and forth, closing the day below that number. So in this chart, I would say the bears have a slight advantage, and if we have another pullback, it could get us down all the way to 168.90, but if that support is violated again, that would be a big problem for the small caps IWM, because if you zoom out to a daily chart, this is where the gap is. And if the support of the gap is violated twice, then we get a massive problem, because it confirms the weakness in the chart. And it says we need to see lower lows. The Dixie, the dollar index, what's going on here? That cup and handle is playing out beautifully, and the dollar continues to go higher by the day. Every time we get a candle that appears to be a reversal candle, we don't get a confirmation the day after. We're not going to say the rally in the dollar is over until we see 1, a reversal candle, number 2, a confirmation of that, and then number 3, we're not going to wait for that. It's going to be obvious, a break of an important support line. But reading the tea leaves right now, looking at this chart, is it primed to move higher, or is it at the risk of moving down if there is a headwind, let's say the CPI, for example? The answer is, look at the RSI, look at the MACD indicators. They're becoming way overextended. What does that mean? The chart is at the risk of pulling back if there is a reliable catalyst. If the CPI delivers, whatever delivering means, the assumption here is a weaker CPI means a less hawkish Fed, and thus the dollar goes down. If that is the case, that will be good for number 1, equities, number 2, gold. Here's the chart of gold, and again, I'm just reading the tea leaves for you. The dollar is becoming a little overbought. Gold is becoming way oversold. You put 2 and 2 together, we have a rebound coming for gold. Is it going to happen right away from this point on, or is it going to happen at the support of around 1,685? That remains to be seen. But as a trader, I'm watching this closely. Why? I'm waiting to buy calls. Be it in the GLD, be it in the GDX, that doesn't matter. We're waiting for a bounce in gold. That's not going to be confirmed until the dollar cools down. We have a big catalyst tomorrow. We'll see what happens. But for now, here's Brent, crude oil. What's going on here from a 4-hour perspective? The pop from the bull flag did not play out for too long. Matter of fact, the chart could not keep 105.84 support. It failed right away. We have an important headwind, the Saudi visit. A lot of traders don't want to assume the risk by holding crude oil right now. They use the pop to dump right away. The support of 100 is gone for now. Now, you can try to be cute and lower the support line all the way to, let's say, 99 and say, watch out here. The chart of crude is making a double bottom, and it's about to bounce higher. Okay, but what is the tailwind? Could the tailwind be the fact that the Saudis are tapped out and they will tell Biden to get lost? We're not increasing the output at all? That certainly could be the case. So I'm also watching for a rebound in crude. But once the support of 99 is gone, that argument is flushed down the toilet. So you got to trade either way. You got a call options trade, you got a put options trade, depending on the support of 99. A bounce means buying call options, but that has to be supported by a fundamental piece of news. A break below 99 means another flush down and another lower low. Now, when we look at the daily chart, here's the 200 days moving average, and why could this be the support line oil bulls are waiting for? Again, a bounce supported by a piece of fundamental news from the 200 days moving average means we're going long oil again, at least for a trade. On the other hand, A violation of the support of the 200 days moving average and a weekly closing below that means we're about to flush down. That will initiate a put options trade. What about the 10-year yield, the daily chart? What's going on here? It lost the support of 3% for now, yet we're not making anything out of it because we have the important CPI tomorrow, and that will dictate whether this chart moves higher or lower. For now, there's nothing to see from a technical perspective. It's all about the fundamentals, at least for now. What about the TLT weekly chart? What's going on here? Folks, the obvious is the pop is inevitable. The question is, what would be the catalyst? What would be the tailwind for the TLT to bounce higher? My answer is a rush to buy bonds based on fears. These are recession fears. We'll see what happens, but for now, we're watching the MACD indicator. We're watching for a weekly closing showing a green impression on the histogram. That would be a confirmation that the bearish momentum is over and we have a new bullish momentum showing up. What about the VIX 4 hours chart? What's going on here? Look at the MACD. It is showing green impressions in the histogram indicating some strength for the VIX, which means weakness for the SPY. Now, if the VIX continues to move higher, it's going to face 28.16 as resistance. But for now, who has the advantage? The answer is the bulls. Look at the MACD, look at the RSI, look at the pop that we got today. But of course, once again, a broken record. It all depends on the CPI. The fundamentals in this case are more important than the technicals. VXN, the VIX for the NASDAQ, what's going on here? 4 hours perspective, once again. The good news is, for NASDAQ bears, of course, the VXN recaptured 32.72 as support, number one. Number two, it appears, for now, the MACD indicator is about to cross, producing green impressions in the histogram. That would be a confirmation of bullish momentum in the VXN, which means bearish momentum in the Qs. Apple, a daily chart, what's going on here? It almost got to 150, didn't make it. It appears, looking at the candle, it is a weaker looking candle, indicating that perhaps we have a pullback in Apple coming. For now, we don't have a confirmation, number one. Number two, the support of 145 remains intact, at least for now. Keyword for now. Tesla, the souffle, what's happening here? 30 minutes chart, we got the flush down all the way to 700, and now the chart is going back and forth, battling 700 as support and resistance. It managed to close below 700 for now, yet the weekly closing on Friday is what really counts. If the chart closes the week below 700, that would be a confirmation that the bears should double down on the shorts. If it closes above 700, it means the bulls should double down on perhaps a summer rally. What about Bitcoin? What's going on here? We follow up on the last video. Here's a 1 hour chart for Bitcoin. We talked about the curve, resistance over and over and over and over again. And then we talked about the support at around 20,450. And the chart went back and forth at around that support. It finally gave up. It couldn't hold, and it went down all the way to the next support at around 19,550, and it lost that support today, at least for now. Can Bitcoin do any repair job? Yes, it can, but it needs to climb above 19,550, better yet 20,000, by tomorrow, if the CPI permits a risk-on kind of mood. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the most important CPI, the Consumer Price Index, and then we have the Beige Book from the Fed. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.